So first of all, we see that the growth is less synchronized than last year. And there are growth signs that is starting to decelerate in Europe because of the consumption rate. Second, there is a monetary tightening instead of monetary easing that is coming on, and this will have an impact on the liquidity of the market. So this will have an impact on market stress of the market, and we think there will be much more volatility going forward than has been in the last 10 years.
We had a recent shift with the ECB becoming really optimistic, like only last week. Do you think they're right to be optimistic about the outlook?
Yes, I think they are right, because I think it's important. We also see some inflation pressure in Europe coming back. So I think it's important that they take into account that the market has recovered and the economy has recovered, and that now they have to start QE tightening and get out of this liquidity that they have put in the market.
What would you think will be the market reaction to a tightening also of monetary policy here on the ground in Europe?
I think it's still not completely priced in the market in Europe. It's more in the US. It could be a source of volatility in the market.
Okay, let us look at the US, because obviously also the US has stellar growth and will continue to hike rates. What will that mean for the US dollar in your view?
I think for the US dollar, it's a good news because obviously the rates are going up. The growth is the strongest in the world and more in terms of developed economy. So I think it's a good news for the dollar and for the US economy.
Is that also, in your view, positive for US equities? Would you say they are in a better position than, say, European equities?
So the answer is a bit both ways. So first of all, I think it's true to say that equity tend to perform well when interest rates go up, because generally interest rates go up when the economy is good. So this is the positive news for the US economy. The bad news is that they are quite highly valued already, and we saw with the result the earnings season in February. Although the earnings season was very good, the markets didn't react so much to the earnings season. So we see that there is a lot of valuation pressure on the market, but on a general trend, we still believe that markets should be influenced by the fact that the macroeconomic environment is good, but there will be an episode of volatility like February's with big bumps in the road.
Yeah, big bumps we have already seen in emerging markets because of the higher or the appreciation of the dollar. Is that something you are expecting to continue, or would you say that there will be a little bit of a reprieve there?
I think on emerging market, the situation is more complex because the higher dollar and interest rate going up have an influence on the emerging market economy directly. So the difference between the US and the emerging market is that the growth is less solid in the emerging market. Obviously, China is a big mystery because it's an economy that has worked by infrastructure-led spending, and now is going on to consumption with a high level of debt in terms of the country. So it's a transformation mode. So for emerging market, it will be more tricky because obviously interest rate going up could have an impact on their growth.
And where are you putting your money on this year?
More in developed market, in equity, in private equity, and in liquid alternative. So equity and private equity in order to boost return, because we still believe that we are in a macro growth environment, but also we put liquid alternative as a diversification and a hedge to the portfolio.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.